All right, hello everyone, and welcome to a really fast recap of monetary policy. Someone seemed to like my budgetary policy really fast recap, so let's try and talk about monetary policy in 8 minutes or less. Let's see what we can do. So first up, the role of the RBA in respect to monetary policy outlined in its charter. So what monetary policy is essentially how the RBA manipulates the cash rate to affect interest rates. The cash rate or interest rates, the cash rate being the amount of interest being charged to banks on money from the money supply, interest rates being what the level of interest banks charge people who borrow money from them, or the amount people receive for saving with those financial institutions. So the RBA aims to stabilise the level of economic activity to maximise living standards while achieving three main key goals from their charter, which is from their website. One is the stability of the Australian currency. So why this is important is that it means that the Australian dollar isn't jumping around like crazy. It means that we're going to have a consistency in our exports and imports, which is going to be good. Like if you were buying our exports, you really don't want the Australian dollar to be going from 60 cents to 70 cents up and down all the time, because that is going to be really bad for your consistency. You're not going to want to buy from us, and then you'll probably go buy from someone else whose dollar is stable. They want to maintain full employment in Australia. That's really, really important at the moment. So at the moment, we aren't really targeting the goal of low inflation because one of the weaknesses that we'll get to of monetary policy, it's not really effective in a downturn. Because people are so in debt in Australia, we have about 185% debt to income. This means that people don't want to borrow money. They're worried about the future. They're worried about their jobs not having them in the future. So therefore, people aren't spending money. So it's not working to stimulate aggregate demand. What's working instead is by having low interest rates. It means businesses are more likely to conduct private investment spending because it's cheaper to do so. It also means the cost of production for businesses is down, which means they're more likely to maintain levels of employment. So with that private investment spending going up, increases aggregate demand, increases the derived demand for labor, helps to achieve the goal of full employment. Then we've got economic prosperity and the welfare of Australian people. So basically that just means the economy going as good as possible, maximising living standards. When interest rates are low, it means we've got more disposable income because we're paying less in interest on loans. Great. So then, contractionary monetary policy, what the RBA does to make interest rates go up. So first, the RBA will announce a rise in the cash rate target and provide a detailed explanation of reasons. They have to say why they're doing it. They'll set out to achieve this by selling government securities at a discounted rate in the short-term money market. Financial institutions want profits, so they'll buy them. This means that financial institutions take money out of the short-term money market and give it to the RBA for those securities. This reduces the supply of cash in the short-term money market, and that causes an increase in interest rates because there's a shortage that drives interest rates up. Then for expansionary monetary policy, the exact same thing, but the opposite. So first, the RBA announces a fall in the cash rate target, provides a detailed explanation of reasons why. So like last year, they decreased to 0.1, and that was because the ongoing pandemic. They wanted to maintain, help achieve the full employment, as well as lowering people's interest burden on their loans. So they set out to achieve this by buying back government securities at a discounted rate in the short-term money market. Financial institutions love profits, so they sell them back because they're going to make money from it. And this money is exchanged with the RBA. It goes back into the money supply. This increases the supply of cash in the short-term money market. Because there is more cash in the short-term money market, this puts downward pressure on the cash rate, which should then flow on to lower interest rates from banks as people are now able to borrow money at a decreased rate. Transmission mechanisms of monetary policy and their influence on the level of aggregate demand. So there's five main transmission mechanisms: savings and investment, cash flow channel, availability of credit channel, exchange rate movements channel, and asset prices channel. So savings and investment channel is also sometimes called cost of credit. So when interest rates go up, it means that people are rewarded for saving and they are punished for borrowing. So it just means that if interest rates go up and you're saving, that's going to get you more money back in for that saving. If you're borrowing, it's going to cost you more for that borrowing. Cash flow channel, basically when interest rates go down, it means you've got less interest burden on your loans, and therefore you've got more disposable income. The opposite is true for all of these as well. Availability of credit channel, when interest rates go up, it means the supply of credit or money is usually going down. And this also means people are less likely to meet the criteria to lend money. So banks aren't going to give people money willy-nilly if there's not much supply of money. So they're going to have stricter criteria. People are going to struggle to meet that. The exchange rate movements channels, when there is a decrease in interest rates, there's a decrease in foreign investment. This means because foreign investors will remove their money from Australian financial institutions in search of better returns elsewhere. And this means that there's going to be a higher supply of Australian dollars on the foreign exchange market, which puts downward pressure on the exchange rate. Then we've got the asset prices channel. So when interest rates decrease, this creates an increase in demand for assets like houses, and this puts upward pressure on asset prices. All of these transmission mechanisms basically give you a step-by-step way of answering questions in relation to how interest rates affect the economy. Then Stance of monetary policy, expansionary or contractionary. When the cash rate is lowered, that's expansionary. When the cash rate is increased, there's contractionary stance. Sometimes you also get that at certain levels it's considered expansionary and contractionary, but that's kind of iffy at the moment based on how the world has changed and what is considered expansionary or contractionary. At the moment, I believe it's anything under 1.5% is considered expansionary. So the focus of monetary policy from the past 2 years on the levels of aggregate demand and the domestic macroeconomic goals over the past 2 years, we've decreased to a record low cash rate of 0.1% as of August 2020, which is likely to be maintained into the near future. They're expecting we're going to stay at that for the next 3 to 4 years unless a lot changes in the economy all of a sudden. So this is aimed to stimulate the economy via both household and business investment in attempts to achieve the goal of full employment, as achieving low inflation is not currently feasible. This is also aimed to increase household disposable incomes as interest repayments on loans become a smaller expense, which should lead to increased private consumption spending and increased aggregate demand overall. Hopefully that would then create an increase in demand for production. Businesses would increase their production, help us achieve that goal of strong, sustainable economic growth. Lastly, the strengths and weaknesses of monetary policy to achieve the Australian government's domestic macroeconomic goals and how these may affect living standards. So first up, a strength is a short implementation lag. So interest rate cuts can happen within 24 hours of the cash rate cut announcement. So it might get announced on the first Tuesday of a month. On that Wednesday, interest rate cuts have been passed on to consumers and businesses. That is excellent. That means it comes into effect really quickly. If you're trying to give people more disposable income, it's happening almost instantly. It's also independent from the government, which means they can make decisions free from political bias. So if they don't agree with how the government is setting their budgetary policy, they can set monetary policy in a way they believe is going to benefit aggregate demand more. Then for weaknesses, there's a long impact lag. So the full impact of interest rate cuts may take up to 2 years or longer to be felt. This is basically because even if you cut interest rates, people aren't just going to borrow money out of nowhere. You need to plan for that. Like if you're going to buy a house, you have to do research, look at houses, plan out how much you need to borrow, all those things. So it can take a really long time for that full effect to be felt. Also, monetary policy is a blunt instrument, so it can't target specific sectors. So everyone is affected equally by it. So essentially, if interest rates get increased, low-income earners are affected much more negatively than high-income earners. High-income earners are usually benefited from higher interest rates because they have wealth and that they earn more on that wealth. Another weakness, which is not here that I mentioned before, is that it's not really that effective in a downturn, which would be really relevant right now. When consumer confidence and business confidence is low, people fear for the future, and they're not going to borrow money. Therefore, it's not fully effective. There we go. In 7 minutes and 40 seconds, we have gone through all of monetary policy. If you like this, feel free to sign up to my revision lecture where we'll go through this in slightly more detail. We'll potentially also talk about things like quantitative easing and the grey corridor, which keeps coming up a lot for different people. Other than that, feel free to head to my website. There'll be a link below for this revision lecture. If not, www.therunningeconomy.com. If you enjoyed this video and the other video of the budgetary version, well, that's going to be it for these because I want people to come to my revision lecture. I'm not going to keep just putting out all the content for free. All my other content is totally free though, so feel free to check out other videos about these things. Other than that, I hope you have a wonderful day and I'll see you next time. Goodbye.